I think we're going to have a very exciting discussion this morning. We have all the leaders rounded up for a set of very interesting questions, and we will divide the session into two parts. One where they will be answering questions prepared by us, and then we will open the floor for a short Q&A. So if you have any questions, you can keep them till the end, and we will send a micro around the room. So, welcome everyone. Thank you very much for joining us. I have the first question that, it's popping up on every single panel that we're doing lately with leaders because it's such an important topic, the boom in volumes that we have seen lately. So the first question actually came up from a discussion we had at the IFX with the leaders panel. Marc pointed out, you never know what's coming. So do you think that after the boom we have been seeing this year and last year, next year at the London Summit, we will be discussing how to get out of a low. Who wants to take it?
Well, so I think it's completely sustainable. I think what we've seen over the last year, 18 months, is an entirely new cohort of traders coming into the industry, trading a wide variety of products. The product mix may have varied, but what we see is that people are taking control of their own destiny, their financial security, their own asset management and portfolios. It's up to us, each of us, to give them new and exciting things to trade, new opportunities to be responsive. But the way that the industry has developed over the last year or two has been that we've been accretive. It's not been that there's been a massive decline in, say, FX volumes in only compensated by equities. The volume across every instrument has grown. What's going to be interesting is how we respond over 2022. We might see the return of inflation, we might see higher interest rates, so the product mix will undoubtedly change, but I think the sustained high level of volume is here to stay.
Thank you, Matt.
Yeah, on my side, I'd agree with Matthew as well. I think the cohort has expanded tremendously. The lower bracket of trading for us was between the ages of about 35 to 55. That's expanded over to 20 years of age, as young as that. So I think trading is becoming much more of a lifestyle, much more of a habit. I see that once people have grasped into it, it's not going to change. I think they'll become better educated, and there'll be better solutions around that they'll educate themselves towards. So the trading habits might change, but the volume of trading will continue to be to be the same, if not more.
Okay, I think volumes will increase on the long term, simply because we have more participants in the market. We have newcomers, new type of clients, new type of customers. Now, on the short term is a different story. I think in the second half of 2021, it came already down a little bit. Compared to what happens in January, February, March. But I think next year will be a very exciting year. There's a lot of volumes. There is a market correction looming somewhere around. So I think that will have a major impact on volume. So get ready.
So we're bracing for 2022.
Yeah, well, inflation's already picking up, and with that will come higher interest rates. And before COVID and news around vaccinations and vaccination rates, interest rates were the primary driver of FX volatility. So I think we'll be okay for a while. I don't think we'll see negative oil and April 2020 level volatility, but I think we'll be okay.
Let's hope so. Anybody else wants to add anything?
Yes. I think there's been a good increase in trading, so derivative products, foreign exchange, CFDs, etc. But the biggest change that we've seen at Saxo is the rise of the investor client. So people buying and holding cash equities, ETFs, bonds, etc. And I think there's in Europe and the UK a much more engaged client base that are taking control of their future investments themselves and doing it online. As they do their banking online, they're now buying their stocks and shares. And we've seen a big change in the mix of what our clients are trading and investing, and also what our B2B clients are looking to offer to their clients as well. So,
thank you. Related to the volumes, actually, I have a question for you, Andrew. Since you're overlooking the whole volume ecosystem from all of these guys and others, have you seen a different level of increase in the volumes in different broker actors? Has the boom been distributed equally, or has there been any main differences?
I think that's a great question and a great lead on to looking at it from a single broker perspective. We've kind of broken the last 2 years into three phases. Not all increases in volume are created equal. They're great in the moment, but not all of them are sustainable. So initially when COVID happened and we locked down, we saw unprecedentedly high volumes, but also looking into the broker bases and the array of different clients we service, we also saw an exodus of equity. It was a lot of liquidation, it was a lot of short run activity, and I think we, as well as many of our broker clients, were wondering how sustainable that would be. Fortunately came the second phase of COVID, where the stipend-enriched, bored, working from home couch trader or newly innovated investor started looking for new ways to spend their time, take control of their own finances, and that trend led to some really great volumes across the board. And I think we're all asking now, and the crux of the question is, as we return to work, are you carrying your mobile platform back with you and trading at your desk? Is it when your boss comes back and can look over your shoulder again, do you have your charting platform up on that other monitor? And fortunately, the trends we're seeing so far is the answer is yes. And the account opening trends, it's not quite across the board what we've seen from previous years and last year, but it is sustaining. We're not falling back below pre-COVID levels, and I think that's exciting. I think the demographic of the trader, which Peter started to touch on, is a really important thing for our space to be looking at now over the next few years. There's an innovative change happening in self-directed buy and hold investors. There's also a big new trend of TikTok-based new things to invest in that are very speculative and are bordering back onto a gambling mentality that I think this industry spent a decade shaking and regulating out of the space and trying to build investment-grade quality products and platforms. So looking at what traders we attract moving forward will be interesting.
Very interesting. We're actually going to touch upon the gambling side of things a little bit later on, because there was a very interesting opinion mentioned. We'll mention it later, but let me go a little bit into the part of the democratization of trading, because this is something that has happened maybe because of COVID, maybe because of a mix of different assets, but Robinhood has been a big part of this debate. And one of the things that happened is that there was actually a research paper by the Swiss Finance Institute that reported that within the second quarter of 2020, the traders of Robinhood were only 0.2%, but they moved 10% of the market of stocks. And these really freaked out regulators. And basically, they were a little bit threatened, and they have promptly reacted. So how has, since we're in the UK, I'm going to ask about FCA, but feel free to add about other regulators. So how has FCA adjusted or changed their policies following those events? And what is the future in UK for companies that want to democratize trading? Who wants to take it?
So I wouldn't say the FCA's changed a great deal. They disallowed payment for order flow back in 2012, so quite a time back. Some of the continental regulators have disallowed us to advertise that we're zero commission as a reaction to the meme stock hype, I suppose. As far as the rubber hits the road when it comes to market abuse monitoring and reporting, and none of the rules around there have changed. I think what's to come, I hope and expect, is prosecutions. I think pump and dump is illegal. It doesn't matter if you're doing it from a smoke-filled back room or an online Reddit forum. So I think when that starts to happen, similar to Napster and illegal music downloads, you start prosecuting people, and it won't solve the situation, but will certainly temper it. We could go on, but I'll turn the floor over, I suppose.
Anyone else?
Yeah, I think the regulation is in the making. We can expect a lot of regulators now digging in and trying to understand what payment for order flow is. It has to be completely transparent to the clients, and probably part of the debate that happens in the US was that there was a misunderstanding, because if you take Robinhood as an example, the clients of Robinhood are not the end clients making the trades. The clients are the one buying the flow. And I think these created this kind of debate where, say your business model is not transparent enough. And I think, at least in continental Europe, now with MiFID II, there's a lot of new rules that may come in place in next year to try to regulate the market a little bit. So I wouldn't bet too much on this payment for order flow as a business model for Europe. I don't see that happening.
I was actually going to ask, one of the questions was, what's your take on the payment for order flow? Because, again, it has created a lot of debate, and some are for, some are against. There is very strong opinions on Financial Times.
I think
I think it's a good debate to have, a necessary one. I think allowing it and disallowing it can both be the right answer. Allowing it, though, would have to come with rules and requirements that are enforced. So I think the UK likely looked at their resources and said, we don't have enough to enforce rules to make sure this doesn't get gamed to the moon and back, so we're just going to disallow it. I think the US maybe put blinders on, didn't disallow it, and aren't enforcing standards around it either. So, like I said, I think both can be a right answer. If you're asking me my preference, I would love for the rest of the world to disallow it, just so we don't have to build different business models and clearing relationships in kind of the transactional side of our operations differently out in different areas. It would just make it simpler for us if it was just disallowed, and we could all proceed on that basis.
Yeah, Brendan, I agree. For me, payment for order flow it's about transparency. It's about integrity. I think customers need to understand that there's a level playing field. They need to know the rules. They need to educate themselves on it. And payment for order flow can muddy the waters. It can cloud it. But on the other hand, customers also understand that if there's no payment for order flow, then they'll have to pay a commission or a spread or whatever it might be. Technology, regulation, platforms, the whole lot, it doesn't come for free. So ultimately, somebody has to pay for it. But if the customer is entirely clear on what it is they're paying for, how much it will cost them, the implications of the charging structure, then I think you've got an acceptable answer.
Iskender.
Actually, in line with what Matthew was saying, I mean, it's going to better the trading conditions for the underlying clients, but they need to understand at what cost that comes along to it. And I think that's where that question, that debate is taking place. I mean, it will create an unfair market advantage for those who are on the other side of it, but it's finding that balance. Us as a broker, our responsibility is to find the best trading conditions for those clients to trade on. But what's the consequence of that? And I think that's the debate that Brendan had touched on as well.
From a technology standpoint, I think this is a very interesting challenge for us. We don't have any order flow, but we service a lot of the brokers who are looking to provide liquidity out to end traders of different demographics. The way we've approached this, and I think Matt and Iskender hit the nail on the head, it's a zero-sum game. You need to be able to look at things like payment for order flow rebates. Another topic that comes up in this type of debate quite often is last look in the institutional world, and whether or not that's a viable, valid mechanism for executing liquidity in an OTC market. And the way we've approached this is a data-driven exercise. What is the quality of liquidity that you're getting from different LPs? What's the type of order flow you're sending out? There are a lot of mechanisms trickling down, not just new liquidity providers, but new types of liquidity. Full amount liquidity for certain types of traders, payment for order flow driven, spread driven liquidity, and all of these different flavors of liquidity exist within an ecosystem that we're able to analyze and put in front of the broker and help them make a decision. And I think as long as regulators are setting fair rules, and as long as it's transparent whether or not it's a pay for order flow or last look liquidity or full amount stream, I think we as technology providers and brokers that have gone through years of regulatory overhaul and asking to be more regulated and transparent can make those good decisions.
Yes.
Yes, it's true, but the business model of PFOF may not work in Europe. Don't forget that, because in the US it's working because it's very concentrated on the main stocks. You know, in the stock markets in Europe is super fragmented, so it's probably difficult to generate alpha out of a retail order flow, and also if everyone would buy the flows, then as you said, it's a zero-sum game. So if everyone is buying the flow, there is not a lot of alpha to generate out of that. So I think I appreciate the technology. I appreciate the fact that it's a good deal for the end clients, but will it happen in Europe? I would doubt. We will have deep discount brokers, we'll have securities lending, we'll have a lot of those things, but the pure payment for order flow, I'm a little bit hesitant.
Brandon made the point on pay for order flow, and that's the thing that we keep deifying in all of this, but I think it's important to note that there was like a crowdsourced orchestrated gamma squeeze that happened on a stock, and that is also illegal. It's just, it's easier to take a market maker and deify them than find who out Diamond Hands 420 is and go after them. But whatever happened there, what was actually a regulated activity as well, that we should be looking at both sides of these things.
Yeah. Peter.
I think one of the reasons why the regulators are so concerned are things like conflict of interest, best execution, and fee transparency. So as an end client, I would rather know exactly what I'm being charged for the trade that I'm doing and the business that I'm conducting with an institution, rather than I'm sure I must be paying something somewhere, this can't be free, but I have no idea exactly what I'm being charged. It's a bit like when you go to a bureau de change and it says commission-free FX. We all know it's not free because the stand at the airport costs something and the staff, etc. You look at the rate that you're being offered and it's like that. So everything costs something, but I would rather know myself exactly what it is I'm being charged rather than it being charged somewhere down the line.
You know what they say? They say, if it's free, then you're the product, right?
You're definitely paying for it somewhere along the flow. Touching on what you just said, Andrew, let's say that it has involved a lot of democratization, and this has brought up a high level of social, let's say, movement in order to trade simultaneously and all these sort of things, which social media is enabling somehow. So how do you take the public debate on democratization versus education? And how do you cope, if you want to expand as a broker and reach out to as many people as possible, but at the same time you want to limit your risk for them to, conduct illegal activities that they could coordinate easily via social media, etc. What's your take as leaders on this industry on the debate of education and democratization?
From my side, I think it's education is a continuous journey that the clients are going through, and it's more a question of democratization with education as opposed to being versus. And I think with an emphasis on financial literacy, something that we've been focused on in all the markets that we've been going through, you better educate the client in making the right decisions when they're in the market, and as opposed to just following the trends that they see blindly, making the right trading decisions along the way. But democratization is coming. We're seeing it. We're seeing a wider bracket of clients trading with us. But how do you enhance it and put the right controls around it for it to be the right decision for them, the right decision for the brokers, and the regulators to be comfortable with it as well?
Have you, following the Robinhood case and all of these coordination, have you changed your education programs? Have you insisted more on them? Have you created any new tools?
I mean, the FCA has been very, very strict on client appropriateness, and I think that directive has really started to push all brokers to take that into consideration. So definitely education is the first step, and we've used that similar model across all the regions that we're in, from Africa through to Latin America, Asia, Middle East as well. So it works. It creates better credibility for you as a broker, and you're trying to extend that life cycle of the client with you, and what's being demanded of us as a broker is also expanding into different asset classes as well. So yes, there is CFDs, but what other solutions can you open up to them to be able to allow them to diversify those portfolios? And that's a big part of that, is educating them along the way to get to there.
Thank you.
Yes,
Mark?
I think education is about understanding the market dynamics for the client. To see why a stock is moving. Is it pure speculative? Is it because there's a fundamental economical trend behind? I think that's part of our responsibility to show the full picture to the clients. If we take the GameStop example, nobody can say that there was a real economic trend behind the move of the GameStop, and a lot of clients lost money. Many made money, but the one that bought the shares at 480, he most probably lost a lot of money. So our responsibility is to educate the clients in him understanding why a market, why a particular stock is moving, and then he can make his decision whether he wants to play that game or not.
Yeah, I think it's important to actually educate the client about the benefits of a balanced portfolio. Diamond Boy 420 putting their entire life savings in a penny stock is, in all likelihood, not a good idea. But if you've got a good balanced portfolio that offers some more risky leveraged products and some that are less risky, less leveraged, then I think actually the clients over time begin to educate themselves. You can have education programs running on the side, not trying to sort of pump and dump stuff, actually teaching people about economic fundamentals, the drivers of a business, what a valuation is based on. That is what will ultimately build all of us a long-term and sustainable business, and one where we grow in tandem with our clients.
Yeah, proper risk management. I think that's the key here. So making sure that clients know the risks, that they're properly categorized in the first place to make sure that they're only trading products that they should be trading, that they're able to trade, and also letting them know ways that they can hedge and, as Matthew said, balance their portfolio, make sure that they have a rounded set of investments rather than just putting everything into crypto or everything into a penny stock that's going to pump and dump. So,
yeah, when it comes to stocks, traders are making different kind of decisions. Education as to make profit is one of them, but maybe on the GameStop case was a little bit more on belief. Trying to push the market to prove something, right? So in that kind of cases, there is a belief behind the action that they're taking in the market. Another type of trader is the gambler, right? So we're getting into the gambling arena here. There was a report in 2018 by Ernst & Young that said that adding game-like aspects to financial services could help reach users who might otherwise feel reluctant to try investing. And they said gamification could be invaluable in educating clients. So this struck to me because, like you mentioned before, the financial industry has been trying to stay apart, separate from the gambling aspects, but at the same time, if you want to expand, if you want to have a broader reach, and there is a big market in here, Ernst & Young was putting it together with education, and it seems a little bit of a conflicting concept. So what's your take on the gambling traders?
Let's be really clear on two things. Gambling is a highly regulated activity in many, many jurisdictions, just as financial services is. And gamification is about making something enjoyable, intuitive, interesting. It's not gambling. It's completely different. Absolutely different. And there's no crossover, and there never should be, between regulated financial products and gambling. I think we've all spent a long time ensuring that regulated financial services are appropriately regulated. It's not a gambling product, but making something intuitive and enjoyable to learn and grow is absolutely fine.
Yep.
I see democratization as increasing the accessibility to trading, and gamification, education is all part of that. It's not a versus conversation, as is making your platform easier to use and opening an account easier to do, and more access to trading tools and research. That's all part of democratizing retail trading, I think. As far as gamification goes, I think it plays a part. I think it will come down to the priority of your development effort. So you can tell we all have a number of developers in our organizations. We can direct them to add a kazoo noise in a confetti GIF, when someone places their 10th trade, or we can have them, improve the platform. And I'm not saying that in a way of belittling gamification. At some point, it will come to the top of our list too. And any effort that improves the way clients interact with your platform and make better use of the tools that you provided them and the order options that are allowed on the platform, all of that leads to this democratization effort. And if they're having a better experience, clients stay clients for longer, which obviously is good for us. So gamification hasn't come to the top of our priority list development-wise yet, but at some point it will.
I think the balance of that democratization, and we don't have retail clients, but if you've been to these before, I like sharing my opinion on an asset class. I was very specific about how I felt about binary options a while ago. I liked being right about that. I had good thoughts about cryptocurrency 4 or 5 years ago. In saying it's going to stick around, it's still here. We were right, it is. It needs to figure out its identity and what it is. And democratization of understanding a new financial asset class is one thing. The education process that's difficult is explaining, exchanges and security laws and disclosures and some of the inefficiencies of equity markets or some of the more regulated markets are there for a reason. It slows things down so that people are treated fairly so that you know what you're investing in. And so I think what must be so frustrating for this whole group and our whole industry is we've gone through a process of educating clients about more regulated asset classes and the safety of executing on disclosed and understood and well-reported aspects and not just equities, futures, even how the FX industry has gone. And now we see people gravitating towards these new assets that are decentralized with no regulation, and that's great for everybody, and it's really not. And the challenge there becomes finding ways to embrace this trend, this desire to be part of a new and exciting asset class and its use, but educating and drawing back those people that feel they need to go sign up with a broker who's regulated in an island on a lake in Kazakhstan, where we've tried to move back into a much more structured and regulated environment.
Yes, I would agree with you, actually. And I don't like the name gamification, because if you take the GameStop example, every investor, if you forget about the political quest of bringing the ugly hedge funds down, which they didn't actually, because the hedge funds just integrated the GameStop territory in their strategy. But probably every client that invested in GameStop wanted to make money. So it's not about the game; it's about just making a return, you know. And it's maybe a new way, you know. So the power of social media to get organized, to be able to have a more powerful influx to the market with very small retail clients. That's just a new parameter of the trading industry. But gamification for me is something different, and I don't see it happening in the financial industry. It's just the old same story. No, we want to make return.
From my side, I think gamification is, as Andrea had mentioned, very concerning if you focus gamification on the product itself. And we witnessed that with binary options and how the regulators came very hard down on that. I think the gamification needs to be focused more on the client journey and the client experience, and make that as user-friendly as possible. Going back to what I'd mentioned earlier, trading is a lifestyle. And I think the more the learnings that we can take from gamification in terms of building your data architecture, making the right decisions based on the data that you get on observing your client behavior is what direction that brokers similar to ourselves are taking, as opposed to gamifying the product itself and the trading habits of clients.
And eventually it comes down to risk management, right? On the broker side, if you want to access these set of traders that have a different kind of mentality when trading than the classic, let's say, establishment, you need to manage your risk in a different way.
Exactly. I think we need to remember that we're in the business of providing clients with the ability to invest their hard-earned money. And we're obviously very regulated because authorities want to make sure that clients are safe, their money's safe, the way they handle those investments, they're properly educated, and they're allowed to trade instruments that they know what to do. So if clients want to game in financial products, they can open a demo account, and play first to learn how things work, how stop losses work, how to trade a particular instrument. But in real life, there are obviously consequences to how you do that. So, I think we need to remember that it's a very serious long-term plan.
True, and as soon as real money is involved, you have to make sure that you're fair towards the clients, so that you don't suspend security just because it matches your own interests. This was a starting debate, and it was actually never solved. Remember, Robinhood suspended GameStop. They said it was technical issues more than something else, but I have doubts. And I mean that's part of the game. If you provide a service, you have to make sure that you provide a service, even though it would not match your B-book interests.
Thank you. So do you see one of these new trends being in 2022, these as a new revenue stream? I mean, all these new assets, all this popularity on these kind of new stocks and gamified assets. Do you see different revenue streams in 2022? What do you foresee from your position of Overlook? I
mean, from our side, client demand has been towards multi-asset solutions. And that's why we're looking to roll out cash equities, fractional shares, futures and options. And you'd be surprised that our client focus has the clients have started to demand a full service solution and not just CFD margin trading solutions. And we've had to adapt to that. I think cryptos will continue to make a lot of noise, continue to attract a lot of traders in 2022. I don't see that slowing down. But from a brokerage perspective, clients are demanding the A to Z of products. You have to service them, you have to provide them. Otherwise, there's other solutions and there's other providers there.
Yes, the market has become large, multi-assets, totally integrated. And if you want to be successful, you have to be able to provide all those financial instruments. Not only Forex, not only CFDs, equity, bonds, you name it, crypto is important. So, and I think that trend will continue as you want to serve these new type of clients. We all received as a gift sometimes in 2021. If you want to continue 2022, you have to be as broad as possible.
Brendan?
So as far as new revenue streams, CFD Prime is going to be a big one for us, so I'll make my obligatory pitch quick here. We just launched it last week with Integral as the infrastructure and Jump Trading as the first LP. And as far as I know, someone can correct me if I'm wrong, we're the first to pull it off. So we're excited about this. And if anyone interested, come by the booth and speak to Mario.
Anyone else?
Yep. So, Iskandar, Mark, I absolutely second that. I think we've had a period of many years now where we've had very low inflation, we've had negligible interest rates. That's all looking to change. So I think that the client demand for different products will change. And it's up to us to offer those in a multi-product, cross-margined environment, all from one platform where your money is safe and you understand what it is you're getting into.
Exactly. I think as the interest rate landscape adjusts over the next year or so, I think bonds will make a big comeback in popularity. So I think bonds is probably going to be the next big thing.
Andrew, what do you see from your holistic approach?
Yeah, it sounds like we're going to be spending all next year integrating more and more assets and putting more and more ticks through the back end of the technology that drives a lot of these brokers. I think that's the area where we're looking to innovate is continued scale. And I think the last panel handled that question very well in terms of if you look at Moore's Law and the cost of CPU cycles, why isn't technology getting cheaper and cheaper? And it's because you guys keep adding more instruments to your platforms. And I think the last we checked at oneZero, we were handling over 200,000 different individual instruments within our ecosystem, and we just expect that to go up. Handling that, understanding it, the difference between a forward and a spot instrument or a CFD, I think is a critical aspect to managing a holistic multi-asset portfolio as well. So I think we've been really ahead of the curve in integrating exchange data, bringing cash equities, bringing futures into the brokerage space, and now we're seeing more and more demand for access to liquidity in those assets. And by the way, there's still fun stuff going on in FX as well. Refinitiv is being re-platformed by the CME onto exchange technology. The Refinitiv by LSE. We've got EBS being re-platformed by the CME onto good enterprise-grade equity stacks. That's going to increase the pace of markets. The engines that drive interbank liquidity, the stigma against last look and prevalence of faster, more quickly updating order books is going to trickle down throughout the entire industry or trickle up into retail. And the way we have to handle that is aggregating more and more pricing, keeping up with the market, but being able to demonstrate that into a retail platform as well that may not be designed for. We had an LP tick 160,000 times per second in Eurodollar a couple weeks ago, and we're just seeing that increase more and more. So a lot of pressure on scale.
Okay, so Forex is not disappearing. CFDs is not becoming the main trend. We're adding more and more asset classes. Technology becomes more and more complex, and all of it to provide an amazing range of services to all these new traders that are joining the scope. The next and last question is actually about your concerns. What are your concerns for 2022? And I actually want to touch on the payments specifically because it's one of the big pains of brokerages out there. The division of different payment methods at global scale, etc. And it's not many times touched upon. So I want to hear from you. What's your take on payments? Is it a big pain for you? Do you see it improving, getting more complicated? What would you need from the industry?
So we spend a lot of time and effort on connectivity and integration with payment providers, and this is not an area of technology that we particularly want to specialize in. We have to. So I would love to outsource this. We would love for Gateway, and I'm sure I'll learn, of some that are on their way to this here at the show. We would love for Gateway providers to do all the connectivity, to do all the setting and resetting that's necessary to provide sufficient payment options, multiple payment options for all the clients in the 100+ countries that we operate in. I think some are on the way, and I think some may claim that spot already, but we've not found one that covers the breadth and the geographic spread that we have as far as clients go. So if there comes a day sooner than later that we can totally outsource this, we would be thrilled to do that.
Mm-hmm. Yeah, the problem is that payment is a low margin business, so, and it's a risky one on top of it. So everyone that is making payment in US dollars, you know how you need to have a correspondent bank. You know how to interact with them. You may have a lot of questions depending on the size of your transaction. So that's a little bit the problem. So in our case, we are a bank, so it's easier for us to deal with that. But to completely outsource this, because who would take the risk of just doing the payment for a third-party broker without having a proper reward and dealing with the low margins revenue on that business?
Andrew?
Not much to say on the payment gateway side, but in terms of my big concerns looking next year and where we're trying to take a leadership position in driving and ensuring longevity for this space that's come such a long way over the last decade. The knee-jerk reactive trends to the crypto industry really concern me in two ways. One, going 24/7 with a financial brokerage is not a marketing exercise, and too many companies are treating it as such. For us as the backbone to over 300 brokers in this industry, and I learned from getting a marketing email from one of my clients that they've gone 24/7 is a concerning trend for me in terms of how they're managing that risk, and in terms of how we as technology providers need to step into a new role there. It's not just about cryptocurrency. It's about a desire to attract this new demographic of traders that wants to trade on the weekend. And what does that mean for liquidity? What does it mean for operations support? So, when we talk about the cost of technology and running my business, I'm going to take 7 figures out of our bottom line next year to staff the weekends and start to figure out if we can take, the technology of oneZero runs great over the weekend. We know that. People is a big part of our business and operational support. And we're going to be investing in that, buying it out, and attempting to be ahead of a trend that concerns me. And then there's the asset side of it. I think crypto is here to stay. I think it's a good asset class. I think it's interesting and innovative. I don't know if I'm going to buy a house with it or update my base in Clash of Clans with it, but it's going to one of those vectors will play out in the future. I'd be really careful if I was a broker adding every altcoin that my client asked for onto my book. I think there's legitimate ones. I think it's just a matter of time till we figure out one of these latest Doge, Shibu things is a legit pump and dump scheme. And if you're internalizing that risk, if you decide to run a book on it, are you now complicit in that and you're going to take the reputation that everyone in this room, and we've all worked for years to be more regulated, to be more transparent. Let's not slip back into that trend and all of a sudden blemish the industry by jumping on something too quickly.
Any other concerns for 2022?
My top concern at the moment is fitting back into my suits after 2 years of working from home, believe it or not. I'm working on it.
That is a very good.
On that topic, I think for us, it's convincing everyone or finding the right hybrid model between working from home and working from office as well. It's still a debate, it's still a challenge. It's been close to a year in some of the offices that we've had where that debate's still ongoing. London is very much a hybrid model, the length of the commute. And for me, I've always had the thought that when you're in the office, idea creation, collaboration happens at a much faster pace. Working from home is perfect from an operational perspective, completing the daily tasks, and how to find that balance where you can get everyone to brainstorm and plan for the future, because there's so many exciting things happening around there. How to have your finger on the pulse at the same time.
Yeah, that global war for talent is hotter than ever, and so you've got to be able to recruit, retain, empower, and challenge your best people, and that's not going to get any easier.
Yes, what keeps me up at night is try to understand what will be the next trigger of the market correction. I doubt it will be interest rates, because that's factor in the market and we're ready for that, but it will be something unexpected that will have a strong market impact. So let's praise that it will not be too strong.
Thank you very much. Thank you, everyone. Those are the questions that we have at the panel. We're going to open the floor for questions. We have 5 minutes left, so maybe we can take 1, max 2 questions. Yes, over here. Wait, they will give you a microphone. Over here in the front, please.
Good morning. Hello. Hugo Sings from House of Capital. I'm an introducer. Speak to a lot of clients who want to come to companies like yourself. What I've seen is going back to the occasional side of things. In the Netherlands, they have now the AFM, the regulator there, has come up with the idea of launching a digital license for online trading. So you need to qualify for that before you can open an online trading account. It's just hypothetical. It's not there yet. Is it something, as a broker, would you like to see that? Or is it more like it's the client's responsibility to do that? Do their education, look into how to trade online? Yeah, that's...
I'm not sure I heard the question. I got the sense it's, would it, some type of digital token, a license to open a brokerage account at any financial services firm?
Online trading, that's coming from the regulator, the AFM. They are looking into this for the TikTokers, because it's now so easy to get to a broker that they want to protect the client even more.
Again, I'm not certain I got the full gist of the question. As far as if that's this token that you can use as a credential to open an account at FXCM, at any of these firms as well, that would require us outsourcing that critical activity of knowing our customer. It's an intriguing concept. You know, I think kind of a universal pass that says, I've done the tests, I know what a PIP is, I know how to calculate rollover, you know, I know what margin trading means, and you know, it's a double-edged sword and cuts both ways, et cetera. I think some validation there that we can all take some faith and trust in would be helpful, but that's a big leap. You know, to get our compliance officer all to say, yes, we're going to, if the guy's got this token, we trust the validity that is his token, and we trust that that's insured, he's educated to trade the products that we offer. And the products that we offer, like has been highlighted here, change dynamically quite a lot. So a token that gets you to open in a non-leveraged account at a broker would have to be a different, possibly a different token that would allow you to trade risky products, highly leveraged products. So it's an interesting concept you seem to be proposing, but it would be a big leap for compliance sign-off.
It's a bit like if we onboard another financial institution which is regulated. They've already got a badge that says, I'm a well-run institution, I've been looked at by the FSA, et cetera, but we will still have to do KYC, CDD, and other checks on an institution, even though it's regulated. So I guess it may make things easier, but I don't think it would get rid of our responsibilities and obligations to
you want to raise
customer.
your own filters.
I think from my side, I think making it tougher for clients to come and be onboarded with the regulated brokers only pushes them towards unregulated brokers, and that's what we found. So I think finding an internal balance, which is getting the right clients educated, going through the right appropriateness tests, is a better solution, and having the right internal measures as a broker. You don't want to force clients to go offshore. You don't want them to go to those unregulated solutions, because it's going to reverse back to an even bigger problem in the future. So find an internal balance. I think that's the best approach.
Thank you. Any other questions? In the back.
Thank you. Thank you very much. Good morning, everybody. One of the things you asked was about what you're worried about in 2022. Every one of you on the panel is a consumer of market data. I wanted to ask the panel how you think, given the sophistication of policies and licensing, how you intend to deal with all of that going forward as leaders.
We're a distributor of market data, just from oneZero's perspective. I think it's a conversation that we started and have been having with brokers for a couple years now. So I'm excited that the conversation's at the forefront now. I see a lot of exchange data providers, market data providers here. The conversation about paying for market rates is not a new one for us. So that's innovative. I think actually the pushback is now to the exchanges a little bit to say, hey, we're here. We're present in the conversation. We have 100,000 clients sitting out there on a platform, and at $10 a head to get your data, it's prohibitive for me to do so. I want to. We don't want to offer CFDs or derivative-only products. We want to put a basket of popularly traded equities or futures in front of them. And there are a few exchanges out there who have taken the step forward in being innovative on this in the equities world. But as you go further and cast a broader net, I think it's actually up to the exchanges to start to come to the table and understand a demographic of a trader who wants to put $100 of their hard-earned money out there, speculate, invest, do what they want. They can't pay $10 a month for the market data to do so. So finding ways to bridge that gap, I think, is really the next step for this space.
I think where I haven't seen a kind of a future gateway provider, a one-stop shop for payments, I do think there's clear advancements there on data vendors. And we are finding a lot more options as far as that goes. We've been doing this for a long time, so we've got still now relationships directly with each exchange that get renegotiated, and we don't have a lot of cards in our hand as far as leverage goes at each renegotiation. But some of the data vendors that are coming together have really helped evolve that scenario, which is good.
Yeah, exchange data is not cheap, it's not simple. The rules vary in 20 different ways. The rules change quite frequently. So actually, you've got to treat this as a top priority. You need to resource it appropriately. You need to have dedicated teams that just live and breathe it. And I think that plays into the hands of the bigger brokers that have got the ability to do that. And then you can potentially turn this not into a cost of doing business, but actually into a point of differentiation against some of the smaller or less able and competitors.
Thank you very much, everyone. We have run out of time, so I'm afraid we don't have any more time for other questions, but the speakers are going to be here throughout the day, so feel free to grab them. Thank you, everyone, very much for your time. Big round of applause.